Everybody, give me a yes. Everybody. Can you hear me? Okay. Okay. Thank you. Thanks a lot. Okay. Welcome, friends. It's a great morning. We are here to understand a smart wealth creation idea where we are going to add safety to equity so that we can achieve prosperity. So that's the whole idea that we are going to work with. Okay. So first about us, we are Finideas. We are basically SEBI registered investment advisor. First, just disclosure, equity markets are subject to market risk. Before taking any decision regarding your investment, you must consult the same with your investment advisor, and then only you should take a decision for your equity investments. Thank you. Fair enough. So we as a company, we are a SEBI registered investment advisor. We are dealing with more than 75 members of exchange and NSE and BSE. I mean, these members are taking softwares from us, education from us, and most of all, they are taking advising from us, right? We are the 26th company of India who has got its algorithm approved from exchange. We have trained more than 40,000 traders across India. As a mission, our companies, we have a mission for providing transparent solution to everyone for achieving financial freedom. Our vision is we will manage wealth of rupees 6,000 crores and serve HNIs and members of exchange globally by 31st March 2023. Okay, now we as a company, we are present in 3 countries, India, Dubai and USA. In USA, we are running a product on NASDAQ for US clients. In India, we are present in more than 12 cities across India. Now, I would like to give you a lockdown update. During the lockdown, since March 2020, we have conducted more than 150 webinars, wherein we got 27,000 plus registrations. Not only we got registrations, we had participants, 15,000 plus participants attending our webinar, and they invested more than 60 crores in the advisory that we are providing. Currently, the structure that we are going to discuss has an investment of 140 plus crores under our advisory. Okay. So now we will try to understand what the product is all about. It's an index long-term strategy wherein we are going to combine low risk and will try to generate higher returns during the whole product. Okay. Now, when we talk about investments, we have been meeting a lot many investors, and if you will analyze, you will find that if a individual is worth 10 crores or more, his 40, 50, 60% of his investments tends to be into property. If you count his residence, if you count his factory, if you count his office, you'll find that out of 10 crores, he must have invested 5 crores, 6 crores worth in property. Now, question is, why this kind of confidence we have in property? So generally, we tend to get two answers out of those investors. The first confidence that they have in property is that if, I mean, say for example, I have invested 1 crore in property, market may go up, market may go down. That's a different point. I mean, it may go to 1.2 crore, it may go to 80 lakhs. But the one confidence that he has in property is it will never become zero, right? The property is going to be with him and he will get some value out of it. So that's the first confidence that they have in property. And the second confidence they have in property is that today maybe there is some slack in property, but 3 years, 5 years, 10 years down the line, if he holds his property, what he knows for sure is that sooner or later he is going to get his price, and not only price, he will get the returns as well from the property, right? So these are the two confidence that they have in property. But when we go in equity markets, there is no such confidence, right? I mean, you find scripts that goes to zero. I mean, there were scripts which are worth 300 rupees 3 years back, and today they are not worth 35 paisa as well, right? So these kind of scripts we do find in equity market. So if you will see, if you will observe that equity market has an higher risk. Similarly, equally, in equity market, you will find scripts which has given you returns beyond 18-20% year on year over last 30-35 years as well, right? So we have scripts which has given higher returns as well. So you in equity market, you get high return and high risk, right? So given this, we decided that we as an advisor, we are not going to invest in direct equity, right? So then where we are going to invest? We trade in index. Am I clear? Everybody, give me a yes. Are you clear with that? Yes, equity market does have higher risk and higher returns. Okay, great. Thank you. Thanks for your feedback. Great. Right. So now let us understand what is Nifty index. So Nifty index is basically a portfolio of top 50 companies of India. Right. To make it more clear, let's say, today's number one company is Reliance. Second highest valued company is TCS. Third is HDFC Bank, and so on. So there are total 50 companies which are there in the portfolio of Nifty. Right. Now, if you will look at it, there were companies like Satyam Computers, Arcom. I mean, people who have been connected to equity markets must have listened to this name. So Satyam Computers was one of the largest company. It was 40th largest company of India at one point in time, and it was there in index as well. Then what happened? There was some problem in the company, and it went to 51 number. As soon as it went to 51 number, it was removed from index, and the 50th company replaced Satyam. Are you getting my point? So this is the objectively managed mechanism, wherein what they will always have in Nifty is the top 50 companies of India. So today also you have top 50 companies. 5 years back also you are having the top 50 companies of that time, and after 10 years also you are going to have the top 50 companies of that particular time. Are you getting my point? Right. So one confidence that we have when we invest in Nifty is, I mean, the argument is not that Nifty may go up or may go down. That's not what you are discussing. But the point is, the one confidence that we have when we know that it is always going to have top 50 company of India is that Nifty will never become zero. Am I clear? Give me a yes. I mean, this is the one confidence that we can have, that Nifty will never become zero. Okay, thank you. Thanks a lot. Right. Now we analyze this portfolio a bit more. We found that today's number one company, Reliance, is worth around 13 lakh crores. TCS 12 lakh crores. HDFC Bank 8 lakh crores. So if you will look at the total portfolio, it is worth 1.17 crore. Now how does, and the index is currently at 15,000. Now how does this 15,000 move? So what happens is this, let's say this 13 lakh goes to 14 lakh crores. It increases by 1 lakh crore. So your 1.17 becomes 1.18, and this 15,000 goes up. Now let's say this 13 lakh goes down to 12 lakh crore. So this 1.17 become 1.16, and your 15,000 goes down. So this is the mechanism that this index moves in, right? Now, one question that we ask to our investor, we ask to ourselves, and you need to ask to yourself, that today in 2021, India's largest company is worth 13 lakh crore, right? After 10 years, 15 years, whichever will be the largest company of India, it's not necessary it will be Reliance. It is possible that Reliance may not be there after 1 year as well. I mean, Patanjali may go big, or India may have some new Google. I don't know what will happen. But whichever is the India's largest company after 10, 15 years, should it not be worth more than 13 lakh crores? Right. So if this is more than 13 lakh crore, then obviously this 1.17 will be more than 1.17 crore, and this 15,000 will be up from its level. Now I will just present you a data from last 20 years. This is last 20 years data, wherein if somebody has invested in index at any level, right, and he has held it for 3 years or more, he has at least got his own entry price or a better price. Now, this is what the data proves. So the confidence that we had in property, were there were two confidence. One, it will never become zero. Second, sooner or later the price will grow. The same two confidence we have in index as well. First, it will never become zero, and second, sooner or later it will grow in price. Am I clear? Everybody, give me a yes. Is this clear? Right? Why index? I mean, this presentation has three parts. The first part is about what investment vehicle we want to invest into. So the investment vehicle is Nifty, right? Okay. Now I'm presenting you with a poll so that I can understand what kind of audience I'm talking to. Okay. The question is, Have you done any investment in equity or mutual funds till date? Okay, great, great, great. I have 100% of my audience voted till I have invested in equity and mutual funds. Great. So this makes me this okay. You have 3 more seconds to vote. 1, 2, 3. Great. Thank you. So this says that all of you, I mean, all of you has voted, have once or twice or more than that have invested in equity or mutual funds. Great. So you must be able to understand why Nifty is such a beautiful portfolio. Okay, great. Thank you. Thanks a lot. So now let's move on to the second part of the presentation, which says when we were in direct equity, we had higher risk, right? When we invested in index, the risk became lower. Now our target was to have even lower risk. So now what we do is, let's say we purchase Nifty worth 10,000 rupees. What we do is we immediately purchase a downside protection which comes at around 5% per annum. So we pay another 500 rupees. So in all, if you will see, the total cost is 10,500. So the cost to others is 10,000. The cost to us is 10,500. But the confidence now we have is that even if market goes from 10,000 to 5,000 and we have invested 1 crore rupees, it will never go below 95 lakhs. Am I clear? Right? This is the confidence that we are having because we have paid the protection value. Now our agreement is if market goes up, your value increases, right? Because you have invested in Nifty share. But if market goes down, your value is protected, right? So now look at the beauty of the portfolio. If say, let's say for example, market moves from 10,000 to 15,000, others will make 5,000 rupees. You will make 4,500, but still you are happy, right? Market goes from 10,000 to 5,000, others lose 50%. You lose just 5%. You are still happy. Are you getting my mind? If market goes up, you are happy. If market goes down, you are happy. But what happens if market remains in the very same range? What will happen? What will happen is, let's say market is at 10,000 today, right? I'm just giving a market at 15,000 as of now, but I'm giving an example so that we can understand the concept, right? And 10,000 is easy to calculate. So fine. So let's say market is at 10,000 today, and after 4 years, market is still at 10,000. So what will happen? We are paying a protection money of 500 rupees every year. So in the 4 year span, we'll end up paying 2,000 rupees. Are you getting my point? So now this can be a risk. I mean, what will happen is people will be at par after 4 years and we may be down by 20%. So let us analyze this particular scenario. So let's say in 2021, market is at 10,000. After 4 years, market is still at 10,000. Now this is very important for you to understand so that you can understand how the protection is working. Okay, fine. So market was at 10,000, market remains at 10,000 after 4 years. Okay, and we invested 1 crore rupees. Now what I'm doing is I'm just assuming some movement in the market in 2020 because there are 3 years left, right? So let's say in 2022 market goes to 12,000. Okay, in 2023 this 12,000 doesn't sustain, it goes back to 8,000. In 2024 it goes back to 12,000, right? And again it falls down to 10,000, right? Now I have assumed some numbers, and in the first year, because we are going to invest with protection only, so in the first year only, what I will do is I will insure my 1 crore and I will end up paying 5 lakh rupees. Okay, so I have paid 5 lakh rupees. Now market went from 10,000 to 12,000. Our agreement is if market goes up, your value increases. If market goes down, your value is protected. Okay, so now from 10,000 to 12,000, market increased by 20%. Your 1 crore will also increase by 20%. So it will practically become 1.2 crore, right? Now in 2022, market is at 12,000. Your value is 1.2 crore. So now you will protect your 1.2 crore, right? Because now it's a higher value. So again, you will pay another 5% and you will end up paying 6 lakh rupees. Okay. Now in next year, market goes from 12,000 to 8,000. It falls down from 1.2 crore. What will happen to your 1.2 crore? Again, remember our agreement. Our agreement is if market goes up, your value increases. If market goes down, your value remains same, right? So if market if now in this scenario market has went down, so 1.2 crore will remain 1.2 crore. Now here look at the beauty of the protection. This is all about protection, right? Because we had paid this premium, we are protected on the downside. Okay, so now you have 1.2 crore where market is at 8,000. You will again pay 6 lakh rupees. Now market moves from 8,000 to 12,000. There is a rise of 50%. So what will happen to your 1.2 crore? Again, now the scenario in market has went up. If market goes up, your value increases, right? So your 1.2 crore will come 1.8 crore, right? And from 1.8 crore, you will again protect it. You will pay another 9 lakh rupees, and market now moves down from 12,000 to 10,000. So your 1.8 crore will become remain 1.8 crore. So now the point to understand is your 10,000, the index has moved from 10,000 to 10,000 only, but your 1 crore has become 1.8 crore. Now this is not 1.8 crore. You need to consider this cost that we have paid during the period. So we will add up 6 plus 6, 12 plus 5, 17 and 9, 26 lakh. So your net value is 1.54 crore. Am I clear? Everybody, is this clear? That market has remained at the very same level and we have grown. Right. Thank you. Thanks a lot. Great. So now these are my assumed number. I mean, I just took an assumption from 10 to 12, 12 to 8. But if you will look at the real data, you will find that in past 18 years, market Nifty has increased to 13 times. I mean, it was at 1100 level and December 2020 it was around 13,000, right? So it multiplied to 13 times. But if somebody has invested in a strategy wherein if market goes up, your value increases, if market goes down, your value remains protected, his money multiplies to 22 times, right? And if you, even more important part is the risk. And if you look at it, there were years when in Nifty there was a fall of 52%. I mean, imagine a number when your value was worth, your portfolio was worth 1 crore. At the end of the year, it was just 48 lakh rupees, right? While here, our max risk over any year is just 5%. Am I clear? Are you getting my point? So generally people says that if you don't take high risk, you don't get high returns. We believe this statement is absolutely wrong. Had this been correct, I mean, there are people who sell things on credit. I mean, you might have been, if you're into some business, you might also be selling some things in credit. Now, let's say there is a friend of yours who sells things on credit at 1, 2, 3 months. You give him an advice that the person you are selling it for a credit of 3 months, give him a credit of 3 years, right? So his risk will increase because he was giving him a credit of 3 months. Now he's giving a credit of 3 years. His risk will increase, but will his return increase? Probably not. Why? Because after 3 years, probably that person will not be there whom he has given the credit. Are you getting my point? He knows in his business, this person is a good credit. I can give him a credit for 3 months. This person had defaulted in his payment last time. If he will deliver and ask for the payment immediately, right? And this person is not at all a good credit. If you don't pay an advance, don't even deal with him, right? So he categorizes his client. So there is a smart calculation involved, right? So we believe smart calculation gives you high returns. And in this product, our smart calculation is invest in equity markets, but never invest without protection. Okay, now what to emphasize more, Mr. Warren Buffett, the god of investment, he has given 2 rules of investment. What he says is rule number 1, never lose money. And rule number 2, never forget rule number 1. It may sound rhetoric to you, but actually it's emphasizing on a very important point. And it is in equity market, your focus should not be on returns. It should be about safety. If you can protect your money from losing, equity market has a tendency to give you return out of it. Are you getting my point? So this is about emphasizing on safety. Everybody, is this clear? Okay, thank you, thanks a lot. Okay, so there is one more poll for you people. I'm just presenting you a poll. Do you understand basic profile of call options and put options? Everybody, do you understand call options and put options? Okay, 83% of my audience does understand call option, put option. So it will be very, very, very easy for me to explain my product. Okay, and the people who don't know it, no worries. You will still be able to understand the product because I will explain you in a way wherein you can understand, you can relate it with insurance part of it, and you will be able to understand the product. Okay, I'm ending my poll in 3 seconds. 1, 2, 3. Thank you. Thanks for your polling. Okay, so my 73% audience understand this call option, put option. 27% doesn't understand it. For people who don't understand these options, I will advise you to register. We have come up with a free workshop on futures and options on 13th March 2021, wherein we will explain you in a very simple way. Mr. Govind Jawar, my partner, is going to explain you the product, what are options, and how you can use them to reduce your risk from investment. Okay, okay, fine. So I will share you the link for registering this webinar. I mean, this is there, bit.ly/FNO. Okay, now Aman has shared the link. I'm just sharing you again. You can click on this link and you can register to this webinar. It will help you a lot. Okay, fine. So now let us understand the final product that we deal into. Let's say you decide to invest 1 crore rupees in the product. So what we do, I mean, what I'm going to do is I'm going to explain you the whole product in detail, because if you remember, our mission was giving you financial freedom with transparency. So I'm going to be very transparent. I'm going to explain you the whole product. Now listen to it very carefully. Okay, sorry. Let's say you decide to invest 1 crore rupees. So what we do is we bifurcate your fund into two parts: 30 lakhs in equity, 70 lakhs in time. Okay. Now that 30 lakhs in equity, what we do is we immediately go to the market and purchase index ETF. Okay. So what you get is you invested 30 lakh rupees in indexes, it goes directly to your DP. Now, using those 30 lakhs index ETF, what we do is we put them on collateral and we purchase futures worth 70 lakh rupees. Right. So in all, your total investment in Nifty is now 1 crore rupees. It is something like, you can relate it with something like you purchase a property worth 1 crore, wherein you invested 30 lakhs and the bank funded you 70 lakh rupees. Right. So it's a very simple trade that we keep on doing. Sorry, friends. Right. So let's say you have invested 1 crore rupees here. So now what will happen is, if market goes up, you will make profit on 1 crore rupees. If market goes down, you're going to lose on 1 crore rupees. Now this is what we don't want to do. So now we will do the first step of, and that is protection. We don't want that risk, right? So we'll immediately incur first cost, and that is 5% per annum of 1 crore rupees, that is 5 lakh rupees. That's the first cost that we are going to incur. Now second, because we have taken funding here, so the second cost that is going to be there, and that is interest. Now if you will look at current market scenario, if you go to the market and take money on loan, what is the average interest that we tend to pay? 9%, 10%, 12%, right? So that varies. Okay, but here we are getting funding at just 5% per annum. Right. So people treat this as a cost. We treat it as an advantage. Why it is an advantage? Because this 70 lakh which you have taken on funding at 5%, we can easily park our 70 lakhs at 7%, 8%. So we are getting an advantage, an arbitrage, interest arbitrage of 2-3% to save our cost. Are you getting my point? So now we are getting another funding cost, and that is going to be 70 lakhs at 5%. So you are going to incur another 3.5 lakh rupees, right? So in all, now your total cost is 8.5 lakh rupees, wherein you have incurred two things. We have received two things. First, downside protection, and second, funding. Okay. Now, till now I have used just 30 lakhs of yours. Now 70 lakhs which you allocated for debt, we will park it in debt, and we will generate around 7% per annum. Even if you go to FD, you can generate 7%, right? So if you do that, what happens is your 70 lakh generates an interest of 7%. So you save 5 lakh rupees as an interest. So if you look at the overall product, you will find that your net cost is now just 3.5 lakh rupees. Now what you know for sure is, if market goes up, you are going to make return on 1 crore rupees. And if market goes down, your max loss is just 3.5 lakh rupees. Am I clear? Everybody, is this clear? Give me a yes. Is this clear? If market goes up, now after this structuring, what we know for sure is the market goes up, you are going to make a return on 1 crore rupees. And if market goes down, you are going to lose just max 3.5 lakh rupees. Great. Thank you. Thanks a lot. Fine. Now I have a few people who says what, that okay, we are happy with your this 5% protection. Okay, 5 lakh cost is fine with us. This 5% funding, they are very happy with this, right? They say, okay, if I'm receiving money at 5%, I'm very happy. So I'm fine with your 8.5 lakh rupees, right? But what they are not happy with is, they say that you are investing my 70 lakh rupees in a debt when you are saving just 7% on the per annum. They do have avenues where they can generate 9% or more. So what they say that we will give you 30 lakhs in your member account. You generate this whole product and you incur a cost of 8.5 lakh rupees, and let 70 lakhs be with us. We do have some investment avenues, or we have running loan, which is at 9% and more, right? So even if I pay that loan, I will be saving 9%. Are you getting my point? So now this 70 lakh as a client, if you look at the whole client per se, you will find that he's incurring 8.5 lakh rupees at members end, and he's saving 9% on 70 lakh rupees. So what he ends up saving is 6.3 lakh rupees. So his net cost reduces to just 2.2 lakhs. Now this is what we call as a basic plan, right? Wherein the investor parks 30 lakhs at the members end, and he saves interest on remaining 70 lakhs. So if you look at the cost part of it, it was 3.5 lakh rupees in relaxed plan. It reduced by 1.3 lakh rupees, around 30% of saving to a person who can generate 9% or more interest on the remaining 70%. Okay, now we have even advanced investors. What they say, okay, 5% is good. I can park at 9%. This is also what I have. Can I maximize this? Can I take advantage more of this? So now what they say, they ask, can you get me more funding? I mean, you're just getting me 70% funding. Can you get me more funding? So then we ask them one question. I will tell you what is the question. The question is, we ask them, see, we need collateral for funding. So do you have another stock for funding? So they say, yes, we do have stocks. Now this is the plan for people who can park, who has already parked 30 lakhs in other stocks, and they are ready to put that as a collateral. Now, if they want to do that, what we ask them is, you need to invest 30 lakhs as stocks, right? And 10 lakhs as check. Okay, on this, we are going to take 100% funding in futures, right? Because this 30 lakh can be put in on collateral. So now his total investment in Nifty is still 1 crore. If market goes up, he makes money on 1 crore. He loses. If market goes down, he loses on 1 crore, which he don't want to do. So what he does is, first he protects his 1 crore. So he incurs first cost, that is 5 lakh rupees. Okay, now because he has taken full 1 crore on funding, he need to pay interest on that full 1 crore at 5%. So he pays 5 lakh rupees another. So his total cost at members end is 10 lakh rupees. Okay, but he has invested just 10 lakhs here. So he has 90 lakhs to park at 9%. So when he parks there, what happens is, he saves 9% on 90 lakhs. So his saving is 8.1 lakh per annum. So his net cost is even lower, and it is just 1.9 lakh. So originally it was 3.5 lakh rupees, and now it has reduced to 1.9 lakh, almost a saving of 50%, right? 1.6 lakh per annum saved, if you have options to save interest beyond 9% or more. Okay, so this is the whole plan. So you have three plans. You can have relaxed plan, you can use basic plan, you can use power booster plan. Okay, we will discuss more about it in the later part of the presentation, but first there is a question for you, and the question is, do you have any kind of car loan, business loan, CC, term loan, loans from friends or relatives? Okay, I have audience 60%, 67%. Okay, 57% of my audience does not have any loan. 43%, 50 people. Okay, great, great, great. So people who are having loan, okay, I'm just ending this poll in just 3 seconds. 1, 2, 3. Thank you. Great. So I have audience who have some loan. I have audience who don't have loan. If you have loan, you can very well think of power booster. Reason being, you are invested full terms in Nifty. and you can probably save more than 9%, because what I believe is your loans must be beyond 9%. If they are more than 9%, you can definitely look for basic plan or power booster. People who don't have any loan, if you don't have any other opportunity in debt, then I will suggest you should look for relax plan. Otherwise, if you have anything to save 9%, you can look for basic plan or relax plan or power booster. Okay, great, thank you. Fine. So let us say you don't have any opportunity. Let us understand those people, because if the people you have savings, you can have even lower cost. But let's say, let's assume you don't have any plan wherein you can save 9%. So what you can do is you can simply go in relax plan. Go for relax plan, invest a crore of rupees. Okay. Now let's say you invest 1 crore rupees, and let's say in 2002 market was at 1100. Okay, so market went up, you invested 1 crore here, market went up by 71%, you made just 68%. Why 3% less? Because we have a cost. So this is one phenomenon of this product, that if market goes up, you are going to make a bit less in the market. Okay, again next year market went up by 11%, you made just 7%. So this way you made some profits, you made some losses, right? But in all, if you look at the last 18 years, you will find that 1 crore invested has become 22.26 crores multiplied to 22 times. And even more important point to understand is this: in 2007 market was at 6100, in 2008 it was 2900, a fall of 52%, while you lost what? Just 3%. If you look at it, 6100 in 2010 went to 4600 in 2011, a fall of 25%. You lost what? 3%, 3%, 1%. Are you getting my point? So if you look at the product, you will find that in any year we didn't take more than 4% risk, while if you look at the annual compounded return, you will find that it was 18.8%. Am I clear? So if you have money, or if you have friends who are looking for investments wherein they want to protect their retirement, they want to protect their kids' education, right? These are the monies where you don't want to take high risk. So if you're risk, if you're looking for a product wherein you don't want to take risk beyond 7, 8, 10%, and you're fine with 15, 17, 18% return, this product can very well suit you. Okay, thank you. Thanks a lot. Kapilji, I will just answer your question. Which option is giving 9%? Let us understand the other part of it. I will answer your question. Okay, fine. So now let's say, I mean, people do have presentations wherein people come up and say, okay, in last 20 years we made this, we made that. But do you have some recent performance? So friends, I'm presenting you with last 6-year performance, day-to-day analysis of this product, so that you can visualize what will happen if you stand in this product for next 5, 7, 10 years. Okay. So now if you look at it, we started the investment and we neutralized Nifty as well at the same level. I mean, both of them became 100. Okay. Now market went up, we also went up. But when market went down, we also fell down, but didn't fell too much. Market went up, we went up. Market fell down, we fell down. I will just share you the numbers so that it is more clear to you. In 2015, market was at 14% plus of its original level, right? We were 20% plus, right? But when market went down in 2016 to its 90% level of the original starting point, we also fell down, but we were still 12% plus the original level. Again in 2016 September, market recovered to its original 2015 level, 114% plus. But at that point in time, we were plus by 41%. Very interesting. If you look at the recent numbers, 15 Jan 2020, market was at 59% plus of its original level, while we were plus 87% plus. Okay. Now in March 2020, when the drop of Corona came in, you will find that market went to 98% of its original level, while we also dropped, but we dropped just by 16%. Why we are dropping less? If anybody can want to answer, why we are dropping less? Why the drop is so low for us? Yes, because we have that protection, right? So that's the point. So now when market went up to its original level in November 2020, I mean, if you will see, this was 158% plus, again went 58% plus, we were at 94% plus. A new level was made, I mean, market was just 50% plus and we were almost double the value. Are you getting my point? So that's the beauty of protection and beauty of remaining there in the long term. Okay. So now there is one question that comes in: what is the minimum investment? I have given explaining you with an example of 1 crore, but it's not necessary that you start with the 1 crore, right? You can invest in this product with as low as 10 lakh 50,000 rupees. If market is at 14,000, currently it is 15,000, so it's like 11 lakh 25,000 you can start with, right? So within ticket size of just 11 lakh rupees, you can enjoy growth of equity and safety of FT, right? So this is what you can start with. Now I will just compare you all the three products. What will be your minimum investment and what will be your cost? Okay. And Kapilji, you can also, I will answer your question here only. Okay. So listen to this. If, say, for example, you decide to go for a relaxed plan, you need to initially invest 100% of the check. In basic plan, it's just 30% you need to invest at the members end. And in power booster, you need 30% value of stock, that is around 3 lakh stock, and 10% check. In terms of number, if I talk about, if for example you decide to invest 10 lakh rupees in relax plan, you need to shell out a check of 10 lakh rupees. But in the case of basic plan, you need to park just 3 lakh rupees at members end. And in power booster, you need just 1 lakh rupees to start the whole product. Just 1 lakh rupees, right? And if you look at the shares mutual fund investment that you will need, in relax plan, you don't need to park in other shares. In basic, there is no need of new shares. But in power booster, you need to have 3 lakhs worth stock. Okay. Now, Kapilji, if you have a 9% saving product you have, if you have in your hand, you can opt for either basic plan or power booster, because if you look at the cost of it, in 10 lakhs, we are saving just 7%, right? So our net cost is 35,000. But if you go for a basic plan, you will save 9% on 7 lakh rupees. Your cost will be 22,000. And in power booster, you will save 9% on 9 lakh rupees and your cost will be 19,000. Right? So in basic and power booster, if you have any options where you can save 9%, you can very well select basic plan or power booster plan. Kapilji, is this clear? Give me a yes. Is this clear? Okay, okay, fine. Now, let's say I will just share you our commercials as well, because we being transparent, we share you what AMC this is going to be there. So if you decide below 1 crore investment, your AMC will be just 0.75%. So, for example, you decide to invest 10 lakh rupees, you just pay 7,500 as an AMC for 6 months, right? If you go for 1 crore to 5 crore, it is 0.625%, and beyond 5 crores, it is 0.5%, right? So the cost is a pretty low. I will just give you a comparison so that you are clear with what I'm talking about. If you will see, okay. Hello, can you hear me? Okay, okay. Everybody, can you hear me? Okay, fine, fine, fine. I'm so sorry. I think there's some fluctuation in my internet. Okay, great. So if you will compare our cost with other equity products that you have, right? So if you will see in mutual fund, the cost is average expense ratio that you pay is around 1.75%. If you go for a PMS, the average costs are at around 2.5%. But if you compare it with ILTS, the cost is just 1.25% on an average, right? That is annual cost I'm talking about. Okay, now the costs are lower, that is good. What about my performance? So let us compare. If you decide to invest in some equity product or mutual fund or PMS, or index long-term strategy, how is the impact? So now if you will see, initial investment is 10 lakhs in both, right? So the impact is same. I mean, we compare our impact in terms of what? How am I investing? What is my return impact? What is my loss impact, right? This is how you compare. So initially investment is almost same. Now, if say for example, market goes up, market rises by 100%, your mutual funds, your PMS, your equity will almost double, right? So your value will go to 20 lakhs. While here in index long-term strategy, if market double, your value will still reach at 19.6 lakhs only. It won't go double because we are paying a protection cost, but it is still similar, right? But if in case market goes down by 50%, your mutual fund values will go to 5 lakhs, right? So there will be a fall of 50%. While here, our value will not go below 9.6 lakh, right? So the impact here is very low. So now what you are getting is, you are getting advantages of mutual fund rise, market rise, but not the disadvantage of fall in market, right? So that's the whole advantage of this index long-term strategy. Fair enough. I will just brief you the features so that you can be clear with what I'm talking about. Features that we understood: this is the combination of equity and futures, wherein the product is downside protected and it's an index-based strategy. So the profile of this product is a low risk profile. It has a strong past record. I already shared with you. You can see your live account. What happens if you start investing with us? We give you a live back office, or which is updated day-to-day basis, wherein you can see what is my equity investment, where is my future par, where is my protection, what is my P&L, how has I performed against index. So you can see everything at one go, right? There is no lock-in period. Now, this is very interesting. You park your money today and you decide the next day that no, I'm not comfortable, I want to take an exit. You can very well take an exit the very next day and your money will be back in your account in another 2 3 days, whatever the time member takes, right? But the logical period of investment is 5 to 10 years in product. And that, for that matter, if you decide to invest in any equity product, let it be mutual funds, let it be PMS, whatever, your logical, you know, plan to invest must be around 5 to 10 years. You may get returns in 1 2 years, you may take an exit, that's a different point, but your vision should be 5 to 10 years. We have a dedicated team who will be monitoring your funds, your portfolios, day in and day out, right? We do advise you through algorithms. So there is a very objectively managed portfolio. Algorithms help you to avoid greed and fear. Now, that's the worst thing that happens in equity market. I mean, the most people take an exit is either because of a greed or a fear, but when it is being managed by algorithms, they tend to keep on doing the very same thing irrespective of whatever happens in market. So you are getting very systematic advisory through algorithms. You can plan your retirement and higher education. And the most important of all, we, whatever I have said you purchase an equity, you purchase futures, you purchase protection, everything that happens, it happens in your own account. It happens in your own members account. No money except the AMC goes to Finideas. Rest, any money that you park, let's say 10 lakh, 15 lakh, 1 crore, it is always there in your own member account, always in your own control, right? Now there are few questions that I will first try to answer, then I will open the forum for you to answer question whatever you have. Okay, so there is one question that generally people ask, that index is going to rise in long time. I mean, we are at the top, right? So we do come across people who say, what's the point of protection? Protection is going to charge me 4% per annum. It's going to impact that much, right? So what's the point in buying protection if anyway index is going to rise in longer run? So you will be able to understand. We discussed this point. I mean, index is going to rise in longer, and we don't doubt that. But the point is, there is no straight line increase. It is always fluctuating. There are periods when it will go down. There are periods when it will remain in a very strict range. There will be periods when it is going to have strong bull run, right? So when the market is in lull period, when market goes down, this protection will be able to help you survive those periods. I mean, we have taken the example when you understood market goes from 10,000 to 10,000. So practically market has not performed, but still this protection, because of this protection, we made 1 crore to 1.54 crore. So this is buying protection is not the cost. It will provide you two benefits. One, protection when market falls, and growth when market recovers. So both things will is going to there. I mean, it is, you can compare it with an health insurance. When in health insurance you pay premium, in put option, the hedging that we are taking, the downside protection that we are taking, we pay a premium, right? When there is no hospitalization, we tend to feel, why are we paying this health insurance? There's no point. I mean, every year this health premium keeps on going. I don't make a benefit of it. Similar case is going to be there in this particular option as well, when market is not going to have fall. But in 1 year, 2 year, when you actually go for an hospitalization, when 5 years, 7 years, 1 year you go to hospitalization, you know for sure all my premiums have recovered and it has given me an advantage. Plus, over those 7 years, you are having peace of mind. The very same thing happens here as well. Whenever there is a market fall, I mean, if you're looking for an investment for 10 years, you know for sure there will be 2 years when there will be a big drop. There will be 3-4 years when market will be in a range. There will be 3-4 years when market will be in a run. So when there will be a fall in market, this protection will recover all the costs that are incurred till that date. Okay. Now, friends, if you want more updates from us, you can very well click on this link shared by Aman, wherein you can register and we will give you updates on whatever Finideas product that we are coming with. You need to fill up this form. This form is about, if you find this strategy interesting, you just need to mark, are you interested in the strategy? You just click on yes. Our team will contact you back and give you more explanation and help you invest money in this product, right? If you click no, we don't do a spam calling, right? If you click a no, we are not going to call you, right? So if you want to have more information on this product, fill this form and click on yes. Okay. Once we do have a automatic algorithm online wherein you can select. I mean, just like there were some people who are asking, which plan should I select? Relax plan, basic plan, or power booster. So this tool will help you identify. This tool will let you play between various scenarios and help you understand which cost is most suitable to you. So this is also there as an algorithm for you. Okay, I will just give you two updates. One update I have already given. We are coming up with a future options market, a free workshop on 13th March. And we are also coming up with a product with a comparison between property and equity markets, right? You can register on these links if you want to understand why you should be investing property, why we invest in equity, what are the similarities, what are the tax effects, and if you have some questions, right? So if you're considering property and equity, this webinar will be very helpful. And just sharing you a few feedbacks from our clients. Dr. Kokilaben Desai has said that this product is a smart work with innovative ideas, and she has experienced when market falls, her fund has a limited fall. Okay. Sanjay Bhai Shah is a partner in Lemon Financial. He says we are using algorithm for advising the trades and is fully satisfied with planning and execution. We have Shalini as Jane Ma'am investor. She says that she's looking at the growth of equity market with the safety and the technology and smartness. And very important, she has highlighted answer all queries. We believe in giving transparent solutions. We believe to answer all your queries before you onboard the product and post that as well, right? Miss Varsha ji, she is a sub-broker to Social Finance. She says she do not need to worry when the market falls now, and her fund is protected against the worst situations as well. And Mr. Ankit Mehta is a chartered accountant. He says he's making money in a most disciplined way. It's a great strategy to invest into. Okay, now I'm open for your question and answers. Whatever questions you have, I will be very happy to answer. You can put it on chat. I will be very happy to address them in the webinar. If you want to post that also, you can register this link IELTS Bittrex, and if you have more queries, my team will help you out, or we can also have an interaction if you want to. While you are putting your questions, I'm just sharing you this kind of webinar wherein we discuss this product, right? So if you want to understand more, or if you have more friends, if you have friends who are looking for this kind of investment wherein they don't want to take huge risk, market is at top, people are pretty much worried about market falling down. So if they don't want to have a risk of like 6, 7, 8, 10%, this is the range that you are looking at, and they're happy with 15, 17% return, do recommend them to attend this webinar We conduct these webinars every Thursday, 4 p.m. to 5 p.m. and every Sunday, 10 a.m. to 11 a.m. So I will request you to share, spread the word with people. Okay. Kapilji has a question. Great, great. Are we buying heavy weight of equities or Nifty futures or a combination of both? Okay, Kapilji, I think you joined a bit late. This is why you are not clear. I'm just giving you an explanation. We are not stock picking. We are not stock picking in terms of I'm not buying direct equity. We are buying Nifty index only, right? So your investment is always either in Nifty Bs or in Nifty futures. So it is always Nifty. We don't want to get into the intricacies of removing the 51st company, getting the 50th company back. This is not what we are looking at. We want our investor to always be invested into Nifty. He knows that it will be always having the top 50 companies of India. Are you getting my point, Kapilji? So we are not buying the heavyweights. We are buying Nifty futures and Nifty ETFs. Am I clear, Kapilji? Is this clear with you? What I'm? Yes. Okay. Okay. Now there is one more interesting question. Sharanji has asked, what if the current investment is in mutual funds? How do you leverage them? Okay. Sharanji, if you have current investment in mutual funds, you can very well use them in two ways. One way is, see, in mutual funds, what you're going to get. I mean, I'm just, for everybody, I'm just giving this answer. See, what happens in a mutual fund family, if you look at, out of 100 mutual funds, they all of them have some index that they track to, right? And if you look at their performance, either they beat their index by 1 to 3% or they are beaten by the index, right? So either sometimes they are up, sometimes they are down. And if you look at the whole family, you will find 80% of them tend to be beaten by the index and 20% beat the index. And very interestingly, this name keeps on changing every year. So if you're looking for mutual fund investment, and if you're looking in for, I mean, if you're looking for equity investment, what you can very well do is, in mutual fund, you're going to get almost average index return. In ILTS also, you're going to get an average index return, right? But the interesting part is, if market goes down, your mutual fund value is going to go down, while in this product, you are protected on the downside, right? So this way, you can first think of your mutual funds. Now, if you want to continue with your mutual fund and you just want to use them for your investment in ILTS, you can very well use them in Power Booster. But again, this will depend on what mutual funds you have. I will request you fill in that form of ILTS Bittrex. Let my team understand what mutual funds you have, and then they can suggest what will be most suitable to you. Sharanji, this answers your question. Give me a yes. Does this answer your question? If you have any more questions, I will be happy to answer. Okay. Now, Kapilji, you have more questions. How many transactions in a year? Okay. Kapilji, because I believe you understood the product. See, what we are doing, we are purchasing Nifty, Bs, right? ETF. We are purchasing future. We are purchasing protection. We are purchasing debt. Okay. As far as equity goes, I mean, this is a 10 years product. So once you purchase equity, that transaction is not going to happen in another 10 years also, except that we add more equity, right? So that transaction is going to be there. Sorry. Funding that we take, that may vary from 3 months to 12 months. So you may have around 4 trades for transferring your funding to next periods. The protection that we are going to take is going to be for 1 year, and the debt is also going to be for a long-term period. So on an average, if you will look at it, it will be around 15 transactions to 20 transactions over the year. That's the max that we are talking about, right? So somewhere around in this range, these will be the transactions. Okay, is this clear, Kapilji? This answers your question. Okay, fine. Now third question is, let's say I have 1 crore exposure with you, so my portfolio is also 100% protected by puts. I'm sorry, I missed most of the webinar. Yes, Kapilji, this was the main crux of the webinar, that in all point of time, your money, your portfolio is protected on the downside. Okay. Now Ramnik ji is having a question new to this product. What are the expenses attached in percentage and how you make money from this product? Okay, Ramningji, I believe you didn't attend the webinar, or you attended the webinar in the full, so that I answer the question accordingly. You give me an answer to that, I will answer your question. Okay, now Kapilji has question: which brokers are appointed for your algos? We do have tie-up with various brokers, Kapilji. I will request you. I mean, we have India Cements, we have Sher Khan, we have Janam, we have Arawadiwala. There are multiple brokers who we have algo tie-up with. So if you want to have execution through them, we can very well connect with you. If you have your own broker, you fill in that form, you discuss it with one-to-one. We will let you know that we are connected with them or not. Okay. Okay, fine. Ramnik ji has another question. Just to understand overall product, it is essential to know how advisor is making brokerage. Now, that is very, very interesting point. Ramnik ji, interestingly, if you have heard the whole product, you will understand I specifically mentioned that the whole product is run in your own account, right? So there is no brokerage to the advisor. What we are going to charge is the fee which is clearly mentioned in the product. Other than that, we are not charging brokerage on the advisory that we are taking, except that the broker is going to charge you the brokerage. That is your independent tie-up. You can have your own broker if you want to. There is no problem with that. There is no restriction on that this particular broker should be used. Okay, so whatever brokerage is being charged is the part of the broker. We are not involved into that. Okay, Sharanji is saying, I want to use it for IELTS and how to do it. Should there be a transfer? Sharanji, I am very thankful if you are interested in this product. I will request you, please fill in this form, right? Because we can advise you on your personal ground only after we do your KYC, because we are a SEBI registered advisor. SEBI doesn't allow us to give you any specific advice on your portfolio without doing your KYC. So please fill that form. Our team will contact you. They will take you to the process and will help you invest in the product. Okay. Kapilji is saying any technical glitches also happens in past. So how can we manage this? Okay. Kapilji, I believe you're talking about algo glitches that you're talking about. Is this what you're talking about, Kapilji? If yes, okay. I mean, see, we as a company, we have been doing these products like from 2000. We are into algos like what, 2010, right? So if there are glitches, first thing, they are not going to be many trades anyway, right? And if there are some technical glitches, they will be managed, and that's the advisor for, right? So we'll be able to help you out if there are any issues in that. Okay, great, great, great. I have many questions. I'm seriously enjoying it. Okay, so now Kapil, another question. The ROE you are saying net of the brokerage STT. I will take another two questions more actually, or if you have more questions, I will request you all, please fill in the form, because we do have a limitation on the webinar time. But anyway, I will try to answer all your questions so that you are clear with what you are talking about. Okay, the ROA you are saying net of the brokerage, STT, and all of the expenses. Yes, Kapilji. Okay, now Kapilji has a question. I have shown you 4% downside risk, 18.8% return on the last 18 years, right? His question is, are the returns presented after all the expenses? The answer to your Kapilji is yes, after all brokerage, net of set of STT, and even the advisory fee as well, right? So everything has been considered on this. Okay. Okay, now Ramnik ji has some questions. Okay, I'm just running on the chat. Okay, thank. I hope there is no personal intervention of mine at all. Kapil ji, okay. I believe what the question is, Kapil ji, that there won't be any personal intervention of you in the product. This is what your question is. Okay, I will give you the answer to this if you have some other. Okay, you are saying yes. Okay, fine. See, the whole product is advisory based execution. Okay, so the process will always be, we will send you an advisory that this has to be done. You will read it and you will forward it to your broker, or if you're executing yourself, you will do it yourself. If our approved brokers are doing it, you will forward it to the broker, right? But by all means, you will be always aware of what is happening, right? So you need to be involved in terms of, whenever we send you an advisory, you will know that this is what is being advised to me, and then it will be done. So nothing happens without your knowledge in your own account. Everything will be in your knowledge, just that what has to be done will be very much clearly be mentioned by us. Am I clear now, Kapilji? Is this clear? Okay, thank you. Thanks a lot. Thanks a lot, friend. I hope I have answered all the questions that you have asked me. Thanks for asking. Thanks for being such a nice audience, for listening to me very carefully. Thanks a lot, friends. So we are thankful to our partners, India Cement Group, Manishji Ramitri, Hina ma'am, Preeti D'Souza, Manojji Manek, Milinji Darji, USA. I mean, we have been thankful to all our associates. I'm not able to take the name of everybody. I'm sorry for that, right? But you can read the names. These are all our associates, and we are very thankful for them to have for organizing this kind of a webinar. I will just conclude with a word from Larry Height. What he says is there are two basic rules about winning in trading as well as in life. And the first point is if you don't bet, you can't win. If you lose all your chips, you can't bet. I mean, what he's emphasizing is if you don't invest, you can't make money. So, first thing you need to dive in the investment market. And second point is don't dive so hard that you can't come up, right? So, protection is equally important. Okay, so now the last poll question for the day is why, while investing, you give prime focus on what is your primary focus, returns or safety? What is it that you give first preference to? Great, I have a great audience who's saying 80% people are invested in safety, 20% are in return. I'm thankful for your feedback. I'm closing this poll in just 3 seconds. 1, 2, 3. Thank you. Thanks for your feedback. So people who are looking for safety, I believe equity with safety, it will be difficult for you to find this kind of a thing wherein the investment is in your own account. Still, you are getting advantages of equity and safety of FD. So this product can very well suit you. If you're looking for returns as well, if your range is 15, 17, 18%, this product can very well suit you and it will give you the return with safety. Okay, so this is very much, so I'm thankful. If you want to listen more from us, you can connect us on Telegram. This is our Telegram link, okay, which is shared by Aman. You can very well connect to that. If you have more queries, we will be happy to answer. You can send your name marking SWCI on this number, so we will be able to answer to you. This is our Google review page. We will request you all to put in your reviews, whatever experience you had. We will be very happy to receive your reviews on Google. Thank you, friends. Thanks a lot. Thanks for being such a nice audience listening to me for 60 minutes or plus. Thanks a lot. Thanks for attending. I will be there for another 2 minutes. If you have more queries, you can push, or we will be concluding the webinar. Thank you.